The last 2 years, 2023 and 2024, have been wonderful for the S&P 500. Stock market has boomed, and largely it's been fueled by the AI boom with companies like Nvidia, Meta, Amazon, Microsoft, Apple, Tesla, etc., all soaring to new highs. You got Palantir in there as well. It's had a big run, and this has largely been fueled by very rosy expectations. Very strong growth and guidance by Nvidia, very aggressive AI investments by these other major players, and the future is bright, says the market, because AI is going to come in. It's going to cut production costs incredibly, make operations way more efficient. It's going to fuel all these incredible scientific discoveries, medical discoveries, innovation into space and transportation, solve all the world's problems. It's going to also have major inroads into defense applications and have tremendous growth there for companies like Palantir and maybe even some others that get into the space. And so, again, huge growth, huge wealth creation, and the market is pricing all that in. Well, that's all great, but I do not think that 2025 is likely. Again, who knows what's going to happen in the short term? A lot could happen, especially the new president, new policies, all these kind of geopolitical scenarios that could play out. But I don't think that 2025 looks very attractive on a risk-adjusted basis for the S&P 500. And in this video, I'm going to discuss why. Before I get into it, though, if you could please subscribe to my channel, I would greatly appreciate it. I'm trying to grow it and grow my audience, get this out to more people, to make these videos more worthwhile so I can afford to spend the time and effort into them. Thank you so much. Okay, so there are 3 reasons why I do not think that 2025 is going to be as kind to the S&P 500 as the past 2 years have been, and here's why. The first reason is simply that valuations have become extremely stretched. You look at all sorts of popular valuation metrics for the broader market, whether it be the Buffett indicator, the S&P 500 mean reversion, the interest rate indicator, the price to earnings ratio indicator, several others. They all indicate that the market is either overvalued or very overvalued. And so there's just not much more room to run for the market in terms of valuation multiple expansion. Again, like I said, it's because the S&P 500 has become so dominated, with about 33% of it filled with these mega cap tech stocks that are heavy on AI, that, again, this AI boom, the mania could continue a bit longer, but it's getting harder and harder to justify these very stretched valuations that are being assigned to these companies. Meanwhile, the rest of the market has actually already been in a pretty stagnant or even a correction for the past several years, because, again, if the market's not excited about the AI opportunities for a company, there's not a lot else out going on there. Growth has been very slow. Inflation has been persistently high. Interest rates are high. There are a lot of unrest and uncertainty out there. There's even fear about AI disruptions. And so if you're not in the AI bubble, it's not been great for you. And the economy outlook is not great for you either. And so, again, how much higher can this AI bubble expand? It's hard to know, but it seems like it's on borrowed time already based on valuations. Another reason why I'm a little bit bearish, especially when combined with the rich valuations, is simply that I think the market is being too bullish on Federal Reserve rate cuts. And the reason for this is simply because the market has been pricing in very aggressive rate cuts over the next year. They currently expect at least 100, maybe 125 or even more basis point rate cuts between now and the end of next year. It could certainly happen, but interest rates on the long end of the curve don't seem to be too optimistic about that. And certainly even on terms of the rhetoric and the economic data, inflation has been pretty persistent over the last several months. That really has stopped its decelerating trend. In fact, over the past month, some indicators even show that it's slightly reaccelerating. Now, I'm not personally calling for a rapid reacceleration of inflation. Again, it could happen. Depends on how Trump's tariff policies play out, some of his other policies, how other countries respond, et cetera. We could see a short-term spike in inflation. I personally don't think that's the most likely scenario, but I don't necessarily see inflation vanishing either, even with Trump taking office and saying he's going to fix things. I just don't see how inflation just goes away overnight. And so when you combine that with the fact that Jerome Powell, even the chairman of the Fed, has said that the economy is not telling them that they need to be in a hurry with rate cuts, I don't see how the Fed is likely going to reach the market's expectations. They may cut a few times over the next year, but I honestly think the data is pointing to a pause as being the most rational course of action, to see that, hey, we want to see additional evidence that inflation is continuing to decelerate. Again, unless they're fine with 3% inflation being the new norm. If that's the new target, okay, so be it, they're there. But if they if they're really serious about getting down at least close to 2%, they may want to pause and let the market's data play out for them. And so if that happens, again, I think the market may stumble because it's currently expecting rates to fall. If rates don't fall further, again, that could put a dent in the market's momentum, and at the very least, remove reason for it to continue to expand higher. Okay, a third reason why I'm not too optimistic about the S&P 500's 2025 outlook is simply the fact that we have enormous storms brewing on the geopolitical horizons. We have the war in Russia and Ukraine is continuing to grind onward, numerous threats of additional escalation. Potentially it could spread to really more directly involving NATO. Of course, President Trump has said he's going to try to work out a peace agreement there, but who knows if that's actually going to happen. So that's a big threat, could potentially go nuclear if things really go south, if Russia feels desperate. Another risk, of course, is the Middle East. You have Syria recently fell to rebels. The Assad regime is gone. And so that's a lot of unrest there. It's a power vacuum. We're not really sure what government's going to seize power there. Is that going to be Afghanistan 2.0? Is it going to become a terrorist state? Are we going to see a reemergence of an ISIS-type caliphate there? Or is it just going to be another government that ends up taking power that's going to be the puppet of, say, the United States or some other Western country? Or is it going to be a puppet state of Russia like Assad was? We don't know. We'll have to wait and see what plays out there. But again, it's a major risk. Then, of course, you have Iran and Israel have been shooting at each other both directly and indirectly through proxies over the past how many years, but especially since the October 7th attack in Israel. And so that has a threat of emerging, and there's recent rumors about Israel taking out Iran's nuclear sites. If they do that, that's going to be a pretty devastating event for Iran, and they may feel like they have no choice but to go to war with Israel. Of course, the United States is very active in trying to protect Israel as their one of their closest allies in the region. And so again, could that involve the U.S. more directly in a full war? We'll have to see what happens, especially with Trump coming into office here in about a month. Of course, then we turn to the Far East, and that's where the risks are the most significant, not just in terms of the scope and scale of the ferocity of the conflict, but its impact on the economy. Pretty soon, 50% of the world's gross domestic product will be produced in the Asia-Pacific region. And so that makes it increasingly important from a geopolitical standpoint. The United States is pivoting there increasingly. But is it fast enough? I don't know. China has been growing its military very rapidly. Yes, they've had some corruption issues. They've had to remove and investigate various leaders in their military recently. And so some would say that, well, that points to them not even being close to ready to attack Taiwan. But at the same time, other numbers in terms of just the raw number of ships, of airplanes, their military spending, if you really look at it and make an honest assessment, by some metrics, it's actually higher than the United States. And that's not even accounting for the purchasing power parity, which is even more in China's favor because it's much cheaper for them to build something or to hire a soldier than it is for the United States. And obviously, Taiwan is much closer to China than it is the United States. So that gives them another natural advantage. And so China, they've been ramping up the rhetoric. They've been ramping up their military exercises. Their most recent drills around Taiwan described as being the most significant in 3 decades. So there's enormous chance and risk that at any moment China could blockade Taiwan or even outright attack it. And so, in fact, there was a major Air Force commander a couple of years ago said that in his gut, he thinks that 2025 will be the year that China attacks Taiwan. Who knows if that's going to happen, but it's certainly a risk, and the market is not pricing it in at all, it seems like. Of course, then there's conflict with the Philippines, between the Philippines and China, that could turn into a hot war. The U.S. is treaty-bound to defend them. There's increasing rhetoric and threats between North Korea and South Korea, especially with North Korea now sending troops to fight in Ukraine for Russia, and Russia giving them technology and fighter jets and money for that in exchange. And that growing bond, that may give North Korea more confidence and capacity to potentially attack South Korea, or at least start a major conflict there. There's political unrest in South Korea with the recent declaration of martial law that has since been pulled back, but there's certainly unrest there politically. And then you have Japan also building up its military rapidly, Australia building up its military rapidly, India trying to take some safeguards. So again, there's kind of an arms race, growing tensions in the region. It feels like Europe before World War I in many ways, or even before World War II, if you draw parallels between Nazi Germany and communist China today. So there's enormous risk there. And of course, if a war were to break out, especially if it was between the United States and China over Taiwan, that would be a global depression type outcome because, first of all, the semiconductors that Taiwan produces are needed by the world desperately. The most advanced chips are built there. It would put the AI boom, send it to pretty much a screeching halt. A lot of companies like NVIDIA and Microsoft and Amazon, Apple, Google, Tesla, etc., they would all suffer immensely from such an event. The market would just be decimated as a result, especially the S&P 500, which is heavy on those companies. But then also just all the trade that goes on between the United States and China, it would be so disruptive for both economies, which in turn would have ripple effects to other countries. Certainly Japan would probably get pulled into the conflict. There's a good chance South Korea could get pulled into the conflict. Australia, those are all major economies. Russia would likely get involved in some way. Certainly Europe, it would probably just turn into a World War III because North Korea would probably attack South Korea. Russia would take that as an opportunity for them to invade Europe, or at least the war there would likely expand. And then, of course, Iran and Israel. So it would likely spiral into World War III, global depression, massive mayhem, major disruption of the AI boom. Again, it's going to be horrible. Probably a lot of cyber attacks and other domestic terror attacks in the United States by Chinese and Iranian and Russian agents, etc. So again, it would be a nightmare scenario. So again, not to scare you too much, but just to say that this is a huge potential risk, that has enormous downside risk for the market that, again, I don't see it being priced in at all. And so I think that investors need to be careful about the S&P 500. Again, I think it's a great long-term compounder. You can invest in funds like SPY and VOO that have low expense ratios that give you exposure to S&P. That's a great way to do it. But again, I think it's important to be diversified and not be relying solely on a continued AI boom to continue fueling gains for the reasons I just shared in this video. So instead, I think diversification into gold, diversification into undervalued, defensively positioned infrastructure assets and real estate, especially that's essential and concentrated in geopolitically less risky areas. And that's what I'm doing with a lot of my investing. I'm investing a lot in gold. I'm investing a lot in high yield infrastructure and real estate stocks that have strong balance sheets and recession resilient business models, again, that are undervalued. And I think that just creates a more diversified portfolio that helps hedging against some of these negative outcomes. So again, if you liked the video, please give it a like. It would help with its distribution. Let me know your thoughts and subscribe to my channel if you found this insightful. Thank you so much. See you next time.